This LOS is Describe Risk Management of Alternative Investments. Risk Management Overview. Managing risks associated with alternative investments can be challenging because these investments are often characterized by asymmetric risk and return profiles, limited portfolio transparency, and illiquidity. Traditional risk and return measures, such as mean return, standard deviation of returns, and beta, may not provide an adequate picture of characteristics of alternative investments. Moreover, these measures may not be reliable or representative of specific investments. So I put here in big bold red, standard deviation is not the most appropriate risk measure because of issues like fat tails and negative skewness. Returns smoothed by use of model values or use of appraised asset values. So I put here in bold green, you want to use value at risk or the Sortino ratio. And we'll see more about the Sortino ratio in an upcoming slide. When we're looking at alternative investments, there's some other risks that we need to consider as well. For example, the risks from use of derivatives, counterparty risk, liquidity risk, operational and financial risk with regards to derivatives. Performance depends on the manager's skill because we said these are aggressively, actively managed investments. Lack of transparency, illiquidity, which we've mentioned before, and correlations with traditional investment returns vary over time, but they may increase during crisis periods. So a rising tide lifts all boats. Similarly, when things crash, there's sometimes a high correlation between the traditional investments and the hedge funds if there's unexpected big crash, for example, like in 2008. So continuing with risk-return measures, the Sharpe ratio is a risk-return measure frequently reported because of its ease of calculation and understandability. The Sharpe ratio may not be the appropriate risk-return measure for alternative investments because measures of return and standard deviation may not be relevant and reliable given the illiquid nature of the assets. Many alternative investments do not exhibit close to normal distribution of returns, which is a crucial assumption for the validity of a standard deviation as a comprehensive risk measure. Alternative investment returns tend to be leptokurtic, negatively skewed, i.e. they have fat tails characterized by positive average returns and long tails downside characterized by potential extreme losses. For this reason, a measure of downside risk, ideally non-normal, would be useful. Downside risk measures focus on the left side of the return distribution curve where losses occur. So for example, value at risk is a measure of the minimum amount of loss expected over a given time period at a given level of probability. So continuing now with risk-return measures, shortfall or safety first risk measures the probability that the portfolio value will fall below some minimum acceptable level over a given time period. And now we're seeing the Sortino ratio. The Sortino ratio is another measure of downside risk, and it uses downside deviation rather than standard deviation as a measure of risk, okay? It uses downside deviation. Assuming normal probability distributions when calculating these measures will lead to an underestimation of downside risk for a negatively skewed distribution because we said the returns to alternative investments are not normal distributions, often negatively skewed, okay? So understanding and evaluating the tail events, low probability, high severity instances of stress is an important yet extraordinarily difficult aspect of the risk management process. Stress testing scenario analysis is often used as a complement to value at risk to develop a better understanding of the potential loss of a portfolio under both normal and stressed market conditions. Stress testing involves estimating losses under extremely unfavorable conditions. And we'll just finish this LOS with one last practice question. An analyst wanting to assess the downside risk of an alternative investment is least likely to use the investment's A, Sortino ratio, B, value at risk, or C, standard deviation of returns? Okay, I think you'd agree with me that that's a pretty easy question if you're up to speed on the CFA curriculum, okay? So an analyst wanting to assess the downside risk of an alternative investment is most likely to use the Sortino ratio or value at risk, least likely to use the standard deviation of returns. So this is a least likely, we're looking for the negative, so the false, and it's standard deviation of returns. Downside risk measures focus on the left side of the return distribution curve where losses occur. The standard deviation of returns assumes that returns are normally distributed. Many alternative investments do not exhibit close to normal distribution of returns, which is a crucial assumption for the validity of a standard deviation as a comprehensive risk measure. Assuming normal probability distributions when calculating these measures will lead to an underestimation of downside risk for a negatively skewed distribution. Both the Sortino ratio and the value at risk measure are both measures of downside risk. And that's the last slide for this LOS. Thank you.